The entire financial system rests upon very weak foundation. Cracks appeared in 2007 and we saw a near total collapse in 2009. There was a temporary rescue shortly thereafter, and unfortunately was never actually corrected. Well, that fragility has increased today, and there will be a point in time in which we must pay the price. What goes around, comes around. You came here for the truth, so let me unveil that for you. We are going to look at what has been happening in the financial system, and I want to begin with this. Fasanara puts out some good reports. I've used them as a source before. I want to show you this. The aspect of today's markets that worries us the most and for which we positioned our funds is the one-sided risk of the investor community. Long only, fully invested, short volatility, short convexity. This article is out of Zero Hedge. It's all one single giant $22 trillion position. And what they're talking about here, the end result is that today it's all one single giant position and market risk became systemic risk. It gets further into it. Talks about here positive feedback loops are synonymous to market complacency and help asset volatility go lower. Think about where the VIX has gone over the years here. Yes, there have been a few blips along the way, but ultimately it made its way down to the ground, and then out of nowhere, no one suspected that it would happen. It shot up to the sky. All right, now they have this chart here, systemic risk, funds, not just banks. You will see for yourself the $22 trillion. Concentration of risks clearly has escalated in recent years. When we look at where it was, financial crisis and onward, we can definitely see that we have a very, very big problem on our hands. Where all of the money is, where all of the capital is flowing, where there are these breaking points, seems to be getting worse and worse as time goes on. You need to spread out the risk on an individual level. Funds need to do that as well. You need to see more geopolitical, geographic diversification, but it doesn't work like that. It's all flowing into the same things. Everything is making the same trades because all the algorithms are doing so. Well, when you do that, it doesn't end up well. Eventually, you have a very big problem, bigger than anyone could have imagined. So you have an individual like Ray Dalio with Bridgewater. In just 1 week, Bridgewater, the world's biggest hedge fund firm, more than quadrupled how much is betting against European Union companies. They have at least $13 billion in shorts or wagers that a stock will fall. That's not a small number. So they've quadrupled just recently. And that is an incredible bet. They might lose. They definitely might lose that bet. But we'll see. That's up from $3 billion that had disclosed on February 1st. So in a very short period of time, they increased their positions. They are seeing something coming. I don't know what it is exactly, but essentially they are worried about the risk. They believe that now is the time to get in on some more shorts. This is the European Union, obviously different than what we are talking about, but it doesn't matter. It's global. It's contagion. It's going to spread everywhere when it does happen. If something begins to fall in Europe, I definitely would have to figure that a similar effect would occur in the US. If not temporarily, we'll see that occurring. It would have to be at least this period of time of uncertainty. So you see the volatility pick up. You see a lot of selling going on. There's a lot of panic that exists. Maybe it'll find itself in a balance. Maybe you'll see that money will begin to flow into what they would call safe havens and this and that. But regardless, a $13 billion bet, it's a big bet. Bridgewater in the past week put more than $1 billion to work against the oil giant, total SA. And actually, I can show you that. Bridgewater has expanded its short positions throughout Europe over the last week. Whether it's total, whether it's in Tesla, it doesn't matter. Look at the size of these bets that they are taking right now. Italy is one of the big ones, but obviously they're looking around Europe, France, Spain, Netherlands as well. So they're basically just betting that Europe is going to fall at least to one degree or another. Italy, up until this point, I believe, was their major short position, but it seems like France has also entered the list. This is a big deal because of what's going on in Europe. You see the European Union really, really struggling. They are engaging in massive quantitative easing programs, printing up money and buying up corporate garbage debt. And that's, of course, never a resolution, but they're doing it anyway. This here is going to present itself a very big problem because they can never relax on that. As soon as they do, the market's going to fall and they'll have to get back into the game yet again. You have interest rates that are running into the negative territory. You have companies that literally need this lifeline that they've been given. And if they don't get it, they're going to fall apart. So the ECB has this very big problem on their hands, quite a predicament. Then you look at the issues that they have with their deflationary pressures, right? You see constantly this environment of deflation. Wages are not doing well there. Businesses are not doing well there. I mean, there are a few and things like this. But of course, that's being supported. You have government subsidies. There's big problems. So Europe's definitely one of the areas, one of the regions of the world that is this, this is me, of all people, saying this. It's worse off than the US. Not in the long term. I mean, the amount of debt, the significant problems that you see in the US, very clear, very evident. But Europe may actually fall first. And that's because of the contagion. Yes, it spreads globally, but I believe geographically it tends to spread to the other nations that are very close by. Just as a quick example, Ontario exports, last I read, 87% of their products, services, whatever it might be, to the US. 87%. It's right there. Most of the population lives close to the border. They do business together, and that's the way it works. So it's like that in most places around the world. You're going to have trade partners with those on your borders. Okay, it just makes sense financially, for shipping, for business, deals, everything. That's the way this works. So that's generally the way the contagion happens. But of course, especially this day and age, doesn't need to be that way. I'm just pointing that out, okay? Remember that. All right, quickly, I have a lot to get to, but I just don't want to dwell on too much. The XIV, I just wanted to once again show you this. This is insane. So you had seen what was happening over the years. Clearly, people were just profiting the whole way up. And in an instant, everything changed. Nobody in their right mind predicted this. Those who were, I should say, riding this on the way up. None of them predicted this, that it would happen. But now what's happening? The market is trying to get this to come back up. They're trying to rescue themselves. I don't know what's going to happen here, but ultimately, we have a very big problem on our hands, because if they've doubled down to do this, this is a very, very dangerous policy. Now, shifting gears here, just wanted to cover 3 quick things. This is all about real estate. Sold over the list percentage as of 2016, looking from 2015 to 2016, insanity. Whether you're seeing different areas of California or others here, actually this might be all California, regardless, you're looking at different cities, and it doesn't matter. All of them are selling for over the asking, and not just a small percentage of them. You're looking at, in this case, 91% over the asking price, okay? And that's December 2016. I'm sure it's even worse today. Maybe not all cities, maybe not to this degree, doesn't matter. It's going over the asking. The market is in a complete stage of euphoria. And I know the same thing was happening in Toronto, Vancouver as well. It's quite pervasive in a lot of major cities to sell for over the asking. Now, for some reason, this is a weird phenomenon that was still going on today, but not quite as much. I would definitely have to say in early 2017, it was a very popular thing to do. If you knew the home would sell for, let's say, $2 million, which, of course, it's not a big deal anymore, apparently, $2 million, you would price it at $1.2 million, and then you would do so in order to get more offers. It was a very strange thing, very pervasive, in fact, and all the real estate agents were doing this. I don't know why. Knowing it would sell for $2 million, you price it at 1.2. That could be skewing these numbers as well. Just wanted to mention that. Seattle tops the nation in home price growth. You can see for yourself the national average. If you remember recently, I said I think it's about 6% nationally, 5.8 according to these statistics. So I seem to be relatively close there. And Seattle's one of those regions that has experienced quite a bit of home price growth. I showed you here after Vancouver implemented the 15% foreign buyers tax, immediately the Chinese search engines, the reports that were provided out of there showed that immediately, as soon as that tax was announced, that they would then go and they were searching Seattle real estate. That became a trend on their search engine. Very clear. And of course, that does contribute to what we're seeing here. Why even ordinary homes sell for $500,000 over the list price? Almost a quarter of U.S. home sales were above the asking price last year. That's not a normal event historically, and that's when you know you have a bubble that has appeared. Interest rates are still very low historically, and that's going to be an issue in the coming years because we can see that they'll have to increase them or else everything is going to be completely distorted. There are many pressures trying to push the inflation interest rates higher up throughout 2017 we saw that, and I believe it'll be a worse condition throughout 2018. The Federal Reserve can maintain the current interest rate, but of course they use open market operations. Open market operations are printing money. If they print money, they cause inflation. That's not a good sign for the average person. So we can see what's going to happen. It's not going to be good. The housing prices should be more affordable for people. It's never a good thing. It's only good for speculation, and that's what I worry about the most. That's all for this video. If you found it informative, please give me a thumbs up. You need to support the channel. All you gotta do, give me a thumbs up, subscribe, and comment. That's all you need to do. But I do appreciate everyone who donates to me in one way, shape, or form, whether that's through the Patreon, whether that is through PayPal or cryptocurrencies or anything else. I truly appreciate that very much. Thank you to each and every one of you.